A stock increasing the amount it pays in dividends will play a huge role in the total returns and amount of dividend income it can provide for a dividend investor. And recently, we've seen 5 high-yielding dividend stocks announce dividend increases, so let's go ahead and jump into it. The first company that recently hiked its dividend payments is Vici Property, stock ticker VICI. They saw a pretty solid dividend hike of 6.4%, and keep in mind this is a real estate investment trust, so you typically don't see as high of dividend growth rate, so 6.4% is honestly pretty solid, and you can see it pushes that dividend payment up to 41.5 cents per share. Now, the current starting dividend yield for this company is now sitting at 5.29%. If you've been keeping up with real estate investment trusts during 2023, there's no secret they have not performed very well. Year to date, Vici is currently down around 2.79%. But let's go ahead and jump into some of these dividend metrics. If we look at the dividend history for this company, you can see they don't have much history. They started paying out dividends in 2018, but since that time period, they have done a very good job of steadily increasing those dividend payments, going from around 16 cents per share every single quarter all the way up to 42 cents per share every single quarter. So overall, really solid history of dividend growth. If we look at these dividend growth rates, we can see the 3-year sitting at around 9.44% and the 5-year sitting very high at almost 30%. Now, I definitely don't expect it to remain that high moving forward in the coming years, but I do expect them to see better dividend growth rates than most real estate investment trusts. Now, when we look at their dividend safety, we need to keep in mind this is a real estate investment trust. So what does that mean? Well, it means we actually don't need to be looking at the payout ratio when looking at a real estate investment trust. A much better metric to look at would be the FFO payout ratio or the AFFO payout ratio. And we can see AFFO stands for adjusted funds from operation, and the payout ratio for the forward-looking AFFO sitting right at 75.28%. So that's a very healthy range. That's actually right in line with where their management wants to see their AFFO payout ratio. So the next thing I want to do is I want to jump over to my stock valuation spreadsheet and run this company through my dividend discount model. And basically, this is a way to value a company based on how much they pay out in dividends and how much that dividend is increasing year over year. So what I've done is I plugged in their quarterly dividends right here so we can see those yearly dividend payouts. And we can see those year-over-year dividend increases. We see 10.7%, 9%, 8.3%, and 6.4%. So that's an average growth rate over the past few years of 8.64%. So again, really solid dividend growth. So if we project a dividend growth rate moving forward of 4.25% and a discount rate of 8.5%, we come to a dividend discount model price per share of $40.72. So it would appear this company is currently a little undervalued according to the dividend discount model. The second company that has recently increased their dividend payouts is Altria Group, stock ticker MO, currently trading at $43.41 per share. Now, this is a high yielding company that just increased its dividend by 4.3%. So we can see that push their starting dividend yield to over 9%, now sitting at 9.01%. So yes, very high yielding dividend company, but here's what's impressive. If we look at their dividend growth rates over the last few years, you can see the 3-year sitting at around 4%, the 5-year dividend growth rate close to 6%, and the 10-year dividend growth rate close to 7.76%. So you don't typically see high-yielding companies with growth rates that high, but here's what's even more impressive. With that high of a starting dividend yield and that high of dividend growth rates, they've still been increasing dividend payments for 53 consecutive years, making them a dividend king. So when we look at this dividend history, this is clearly a company that is seeking to reward their shareholders in the form of dividends. So when we look at 10 years ago, that dividend payment was around 44 cents per share quarterly. Jump forward to now sitting at 98 cents per share every single quarter. Now, obviously, the question we need to answer for any high yielding investment or for any dividend stock for that matter is how safe is that dividend? And off first glance, when we look at this dividend payout ratio, it is extremely close to 100%. So for most people, that's a huge red flag, and really it should be, but we do need to dig into this a little bit more. The more important ratio we need to be looking at is the cash flow payout ratio. Dividends are paid out of free cash flow, so in my opinion, the cash flow payout ratio is much more important to look at. And we can see the cash flow payout ratio sitting at 82.51%. Again, that's quite a bit higher than I typically like to see it, but for a company like MO, they typically want to reward their shareholders in the form of dividends more than anything else, so it is a little bit more normal to see this. Now, if this cash flow payout ratio does continue to climb much higher, that will start to concern me a little bit. So the big question is, can they continue to grow their free cash flow at a healthy enough rate to continue to increase the dividends without increasing the cash flow payout ratio? But with that being said, that's definitely something to look at. But let's go ahead and jump back over to my stock valuation spreadsheet. Again, you can download this on my Patreon page, link in the description. But again, let's run it through the dividend discount model. So I plugged in the quarterly dividend payment so we can see how much they pay out each year. And the dividend growth rate's a little bit lower over the last few years. We have 2.4, 4.6, 4.4, and 4.3. That's an average growth rate of 3.9%. 0.93. Moving forward, I'm projecting a slightly lower growth rate of around 2.5% and a discount rate of around 9%. So when we plug all this in, we come to a dividend discount model price per share of $61.82. So according to our dividend discount model, it does look like MO is currently slightly undervalued. The third company that recently saw a dividend hike was Philip Morris International, stock ticker PM. Now this company saw a lower dividend growth rate. It was only around 2.4%. If we jump back over to Seeking Alpha, which by the way you can get a discount on at my link in the description, you can see their current yield is sitting at 5.43%. So still a relatively high starting dividend yield, but if we look at them year to date, we can see they're down around 4.45%. Let's go ahead and dig into the dividend history for this company. We can see, again, pretty good history of dividend growth, 14 straight years. And if we look 10 years ago, they were paying out around 85 cents per share quarterly. Jump forward to now around $1.30. If we look at the dividend growth rates, you can see the dividend growth has slowed a little bit over the past decade. Past 3-year dividend growth rate around 2.77%, 5-year dividend growth rate 3.15%, and a 10-year a little over 4%. Now again, we need to look at that dividend safety, that extremely important metric. And again, that dividend payout ratio sitting at 98.26%. So that should be something that concerns you a little bit. But again, we want to be looking at that cash flow payout ratio. This is the most important payout ratio in my opinion, and it's currently sitting at around 75%. So that means 75% of their free cash flow is going out to paying dividends. So that leaves around 25% free cash flow to do things like buy back shares, reinvest back into the business, or pay down debt. So that's still a decent amount of free cash flow left to do those things. Now, if we jump over to my stock valuation spreadsheet, again, I plugged in all of the dividend payments and we can see those yearly dividend growth rates. And moving forward, I'm projecting a dividend growth rate of around 2.75%. So with a discount rate of 8.5%, we can see the dividend discount model is actually slightly below the current trading price, meaning it may be slightly overvalued. The fourth company that just hiked its dividend is another real estate investment trust, and that is Realty Income Corporation, stock ticker O, currently trading at $54.17 per share. Now this is a company that pays out dividends every single month, and we can see they just hiked their dividend by 0.2%. Now we need to understand this company actually increases their dividend every 3 months, so this isn't representative of the entire year, but their current dividend payout is now 0.256 cents per share every single month. So if we jump back over to Seeking Alpha, we can see starting dividend yield now sitting very high at 5.68%, and they're trading very close to their 52-week low. They have been absolutely hammered year to date. We can see they're down around 15%. Now this is a company that is actually a dividend aristocrat. They've been increasing dividends for around 25 years, and look at that steady history of increasing their dividend payments. We can see 10 years ago they were paying out around 18 cents per share every single month. Jump forward to now, it's now sitting at 26 cents per share every single month. If we scroll up and look at those dividend growth rates, we'll get a better idea of how they've been increasing their dividends over the past 2 years. You can see the 3-year dividend growth rate pretty decent at around 4%, the 5-year sitting at 3.71%, and the 10-year sitting at 4.28%. Now let's jump over to the dividend safety, and like we already have discussed, we need to scroll down since this is a REIT and look at the AFFO payout ratio sitting at around 76%, and the FFO payout ratio sitting at around 74%. So for a real estate investment trust, it's sitting at a pretty healthy range in my opinion. Now looking at the dividend discount model, again, we can see those year-over-year dividend growth rates hovering around 3% on average. Moving forward, I'm projecting a 3.5% growth rate, discount rate of around 8%, and that gives us a dividend discount model price per share of $70.66. Looks like it's a little undervalued in my opinion. The last high-yielding company that just increased its dividend that we're going to be looking at is Verizon Communications, stock ticker VZ, currently trading at $33.63 per share, and we can see they recently hiked their dividend by around 1.9% to 66.5 cents per share. And if we jump over to Seeking Alpha, we can see that gives them a starting dividend yield sitting very high at 7.87%. Now that dividend growth rate obviously pretty low, and something you need to always keep in mind is anytime you see a dividend growth rate below the rate of inflation, that company is technically paying out less in dividends year over year. Now if we jump into the financial statements, there's something that I want to point out. If we scroll down and look at this metric here, revenue per share, we can virtually see almost no growth over the past 3, 4, or even 5 years when it comes to revenue per share, thus meaning it's extremely hard for them to continue to increase the amount they pay out in dividends, which is why we're seeing the very low dividend growth rates. But with all of that being said, if we look at the dividend history, historically speaking, they've done a pretty good job. Dividend growth has seen 18 consecutive years, and if we look at the 10-year dividend history, we could see 10 years ago they're paying out around 52 cents per share quarterly, and jump forward to now, it's now sitting at around 67 cents. So they have done a decent job of increasing those dividends, but as we'll see from the dividend growth rates, the dividend growth has been pretty subpar. We can see the 3-year dividend growth rate sitting at around 3%, the 5-year dividend growth rate sitting at around 2%, and the 10-year dividend growth rate a little bit above 2%. So overall, they really have not been beating the rate of inflation, which is a little bit of a concern if you're looking for companies that are increasing their dividend payments over time. Now, if we jump into the dividend safety of Verizon, you will see the dividend payments do appear to be a little bit more sustainable. We can see the cash flow payout ratio sitting at around 30.93%. That's actually a pretty healthy range to be in, so that should give you some comfort that these dividend payments do appear to be safe for now. You just can't expect to see a whole lot of growth. So if we jump over to my stock valuation spreadsheet and look at the dividend discount model, you can see I'm staying in line with the recent growth rates of around 2%. That average growth rate was right there at it. So with a discount rate of around 8%, the dividend discount model price per share comes out to around $44.40. So according strictly to the dividend discount model, it looks like it is a little undervalued. Now keep in mind, just because a stock appears to be a little undervalued, there are other valuations that you should typically take into consideration when valuing a stock. And you also need to take into account that not all investments will fit into your investing thesis. Me personally, I typically like to invest in companies that have higher dividend growth rates than just 2%. And you also have to keep in mind things like opportunity cost. Are there better opportunities in the market? But there you go. Those are 5 high-yielding companies that have just increased their dividend payouts. If you'd like to be able to download my stock valuation spreadsheet or get access to any of my other spreadsheets, you can head over to my Patreon page at the link in the description. You can also get a coupon to Seeking Alpha that will give you $50 off and a 7-day free trial at my link in the description. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.